Hey, welcome back to Fintelliq. Before you buy a single stock, a single ETF, before you open a brokerage app and start clicking buy, there are two questions almost nobody asks themselves. And skipping them is the single biggest reason investors panic sell at the worst possible time or even end up with a portfolio that doesn't get them where they want to go. Those two questions are simple: what I am actually investing for and how much loss can I stomach all the way. In the next 20 something minutes, I'm gonna walk you through both of these: investment goals and risk tolerance, what they actually mean, how to figure out your own, and how to line them up so you can build a portfolio that fits your life, not someone else. Let's get into it. Here's the thing about investing that nobody tells you when you are getting started. It's not one size fits all. Your co-worker's portfolio, your favorite finance YouTuber's portfolio, your uncle's portfolio, none of that necessarily works for you because none of it was built around your goals or your tolerance for risk. So, before we talk about what to invest in, and we first you need to nail down two things. The number one, that's what I'm investing for, that's your investment goal. And the second one, how much volatility, how much of a gut punch can I actually handle without doing something dumb like selling everything in a panic. That's your risk tolerance. Think of this way, that your goals are the destination. Risk tolerance is a journey. How bumpy the road is and how much bumpiness you can actually handle without pulling over and quitting. Get both of these right and you are investing with an actual plan. Get them wrong and you are investing with your emotions, and the emotions are terrible at a portfolio manager. You got my point. So let's zoom out for a second and look at the big picture. A solid investment strategy rests on two pillars. The first pillar one is investment goals, the destination. This is what you want your money to actually achieve. It's defined by your time horizon and your purpose, and it's what gives you investing direction and discipline. Without it, you are just throwing money at the market and hoping. And here's the pillar 2, the risk tolerance. The journey. We have previously talked about the investment goals, that was the destination, and now the risk tolerance is the actual journey. This is how much volatility you can actually endure. It's a mix of your psychology and your financial capacity, and it's what determines how comfortable or uncomfortable the ride is gonna feel. Here's the key insight for this whole video. These two pillars have to work together. You can't pick one without the other. The goal without thinking a risk appropriate strategy is wasteful thinking. A risk tolerance without a goal is just sitting in cash and nowhere. So let's break down each of these one, starting with the goals. So what exactly is an investment goal? Simply put, it's a specific financial objective you are aiming to achieve through investing. It gives you purpose, it gives you direction, and it gives you a benchmark to measure your progress against. Here's why this matters so much. Without a clear goal, investing becomes aimless. And your aimless investing is actually emotional investing. If you don't know why you are invested, why you are interested upon that, then when the market drops 10%, you have nothing to anchor yourself to. So you just panic there. But when you have a goal, say I need $200,000 in 18 years for retirement, a 10% dip doesn't feel like a crisis. It feels like a Tuesday because you know you have got time, you know your plan, and you are not derailed by the short term noise. A clear goal does four things for you. The first, it turns a vague intention like I should probably invest into an actual concrete plan. Second, it sets a measurable finish line. So you actually know when you have won. The third, it anchors your decisions during volatile markets, which cuts down on panic selling. And the last, this is the part people miss. It directly tells you how much risk you actually need to take, not how much risk you feel like taking, how much you need. Now, goals are not all the same. The single biggest factor that shapes a goal is time horizon, the time horizon, how far away it is, and generally speaking, the further away your goal is, the more risks you can afford to take on to get there because you have got time to ride out the bumps. Let's break this into three buckets. The short term goals. 1 to 3 years out, think of a vacation, an emergency fund, a down payment on a car. For this, you want high liquidity and low risk. Why? Because if the market drops right before you need that money, you don't have time to wait for it to recover. This money should basically be in cash, yeah, high yield savings or something similarly safe and boring. Now these medium term goals, those are around 3 to 10 years. This is stuff like a house down payment, funding a kid's education or starting a business. Here you can take a moderate level of risk. You are balancing down growth with capital preservation. A blend of stocks and bonds usually fits here. And here's the long-term goals. 10 plus years. The classic example is retirement because your time horizon is so long. You can generally afford a much higher allocation to equities. The equities, stocks, because you have decades to ride out the inevitable ups and downs along the way. Time is your biggest asset here. So, step 1 for you right now, think about your own goals and sort them into 3 buckets. That alone will tell you a lot about how you should be investing for each one. Okay, so your goal is say medium term, but I want to buy a house someday. Isn't actually a goal, it's a wish. To make it useful, you need to be smart. It needs to be smart. SMART, smart. This S specific. Out of the smart, this is SMART, S specific, M measurable, A achievable, R relevant, and T time bound. Out of them, the S specific. Don't say just save for a house save. You should say save for a down payment on a house in my city. M, that's measurable. Put a number on it. Is that $20,000? 60,000? You need an exact target. And there's achievable. Is this realistic given your income? And what you can actually put aside each month. A goal that requires you to save half your paycheck is not a goal, it's a fantasy. Now, relevance. Does this actually align with your broader life plans? Don't save aggressively for a goal you are not even sure you want in 5 years. And the time bound. Set an actual target date in 4 years is usually more useful than eventually. Here is a quick exercise. Pause the video right now and write down one investment goal using all 5 of these. I promise you turning a vague wish into a smart, smart goal is going to change how you invest for it completely. Alright, goals check. Now let's talk about the other pillar, the risk tolerance. The risk tolerance is actually the degree of uncertainty and potential financial loss you are willing to accept in pursuit of higher returns. That's the textbook definition. In plain English, it's how much of a roller coaster you can handle before you want to get off. It's actually a measure of two things at once: your psychological comfort with market swings and your financial capacity to absorb an actual loss. And here's something important. Risk tolerance is not fixed. It shifts as your life changes. A new job, a new kid, getting closer to retirement, all of it moves the needle. Take a look at the chart. That's what real growth actually looks like. It's not a straight line up and to the right. It's up, down, up, and generally trending upward over time. Higher potential gains, higher potential returns almost always come with a bumpier side. If you go into investing expecting a month staircase, the first real dip is going to catch you off guard. The next part is honestly one of the most misunderstood ideas in personal finance. Your overall risk profile actually has two separate components, and people constantly confuse them. The first is risk willingness. This is the psychological side. It's simply when you feel about the possibility of losing money. Some people are just naturally risk averse. They would rather sleep well at night than extra chase. Okay? Now, others are totally fine with the big swings if it means bigger long-term growth. The second is risk capacity. And this is the financial side. This is your objective, factual ability to absorb a loss. It's driven by things like how stable your income is, how your overall net worth, how much debt you are carrying, and critically, the time horizon of your goal. Here's the key insight, and I really want this one to land. You can feel ready for risks and not actually be positioned for it. Or the opposite, you might have a plenty of financial capacities for risks. So, you are just too anxious to actually use it. It's the mismatch between these two gets people into trouble. Someone with a high willingness but a low capacity say they feel fearless but they need that money in 8 months. That's the person who takes a swing, gets hit with a downturn and has to sell at the worst possible time because they actually needed the cash. Know both sides of yourself, not just one side. So, what actually determines where you land your spectrum? A handful of factors, and it's worth knowing them so you can self-assess honestly instead of just guessing. The first, time horizon. The longer it is, the higher your risk capacity, plain and being simple. Second, financial goals. More ambitious goals often require you to take on more risks to have a shot at hitting them. The third, age and life stage. Younger investors generally have more room to recover from a loss, plus more future earning potential to fall back on. As you get closer to retirement, that cushion shrinks and most people shift toward preserving what they have built. Fourth, the income and wealth. The bigger your financial cushion, the more risk capacity you gonna naturally have. And the last, knowledge and experience. The more you understand how markets actually behave, the less a normal garden variety downturn is going to rattle you. Now, notice none of these are about vibes, they are facts about your actual life. Go through this list in your head right now where you honestly land on each one. Okay, so you actually put a number on this instead of just guessing. There are three complementary approaches, and honestly, using more than one gives you a much clearer picture. Number one, risk questionnaires. Most brokerages and advisors have this. They ask you about hypothetical market scenarios, your experience level, your goals. They're good starting point, but I want to be clear. They should never be the only thing you base your strategy on. They are a data point, not a verdict. Number two, self-reflection. This this one's being underrated. Very important thing. Think back. How did you actually react the last time when the market dropped? Did you check the portfolio every 5 minutes and reconsider the selling? Or did you shrug and move on? Try this thought experiment. Imagine a portfolio drops 30% tomorrow. Be honest with yourself. Would you hold or would you panic sell? Your gut reaction there tells you more than any quiz. Number three, talk to a financial advisor. It's a very good thing. A good financial advisor can look at your financial picture, not just willingness, not just capacity, but both together and help you reconcile the two if they don't match up. Combine at least two of these and you will have a far more honest read on yourself with a single 5 minute quiz can give you. Now, let's bring it all together. This is where the two pillars actually meet. Once you know your goal and the risk tolerance, they generally map into one of the three portfolio types. Conservative, this is for low risk tolerance or short-term goals. Heavy on bonds, cash and stable dividend paying stocks. The priority here is protecting what you have, not maximizing your growth. And here is the moderate for medium risk tolerance and medium term goals. There's a common example is rough 60-40 stock to bond blend, balancing growth with a cushion against big swings. And at last, the aggressive for high risk tolerance and long term goals. This is a equity heavy, often including small cap and international stocks. Prioritizing capital growth over stability because you have got the time to absorb the volatile along the way. Notice how directly this connects to everything we already covered. Your time horizon from your goals plus your honest risk profile basically tells you which of these three buckets you belong to or you belong in. This isn't guesswork, it's just about lining up the pieces we already talked about. But here is the problem, the real problem that comes up a lot. What happens when your goal actually requires a high return than your risk tolerance comfortably allows for? Say you need aggressive growth to hit a number, but Every time the market dips, you are losing sleep. When that happens, something has to give, and you basically have three levers to pull. One, adjust the timeline, give your goal the more time to go. Maybe that means retiring a year or two later than you originally planned. Second, save more. If you put in more capital yourself, you reduce how much return you actually need the market to generate, which means you don't have to reach for as much as risk. Third, build your risk comfort gradually. Yes, gradually. This doesn't mean forcing yourself into something you are not ready for. It means slowly educating yourself, understanding the market history, and building genuine comfort with volatile over time, not overnight. That point is you are not stuck if the math doesn't line up. You just adjust one of these three levers instead of just gritting your teeth and hoping for the best. Let's bring it all home. 5 things I want you to walk away with. 1. Your goals define your destination. Your risk tolerance defines how turbulent the ride is going to be. Second, risk tolerance is not just one thing, it's psychological willingness plus financial capacity, and they don't always agree with each other. Third, use the SMART framework to turn vague wishes into goals you can actually act on. And four, resist regularly. Both your goals and your risk tolerance are going to shift as your life goes and as your life shifts. This is not a one and done exercise. And lastly, fifth one, align your portfolio type, conservative, moderate, or being aggressive, to both factors together, not just one. So, before you open the trading app, know your goals, you know your risk tolerance, and then only build the portfolio that actually fits both. If this helped you think about your own investing a little differently, do me a favor and hit the subscribe. Fintelliq puts down out videos like this regularly, breaking down the stuff like actually matters. Before you start putting money into the market, drop a comment and let me know what's your goal and where do you honestly think you land on risk tolerance. I read everyone, and for now, thanks for watching. I will see you in the next one. Bye.